The video is about JM Flexi Cap Fund. It is in existence from 23rd September 2008. It's being managed by Satish Ramanathan since August 2021. Again, the aim of the fund is to appreciate the capital. It is pretty much same across almost all the equity schemes, just they are changing the wordings. So the exit load is 1% if it is redeemed before 30 days. So most of the funds have a exit load applicable for 1 year typically. So this is something which has a lesser time horizon for the exit load. But ideally, for any equity investment, the minimum time horizon has to be 5 years. The benchmark they are following is Nifty 500. So the present AUM is around 4,900 crores. The direct expense ratio is at 0.52%, and the regular is at 1.81%. So again, the entire 1.3%, the additional 1.3%, some of it will be going to the distributor as a commission if you are investing through the regular expense, and there are marketing expenses which are charged on to the client, which are passed on to the client. If your financial advisor is recommending this, if he or she is charging 1% plus GST, then typically what a distributor is charging and what a financial advisor is charging would be something one and the same. And if they are somebody who are helping you with the asset allocation and recommending basis your goals and explaining regarding this fund, then probably it will be worth paying them. Otherwise, it's always better if you can do your own research. Maybe you should go for the direct scheme. Now let's look at the analysis. These are the rolling returns across the time horizons. We have looked at the minimum, max, median, and mean returns. So the 1 to 3 years returns are not much relevant. But despite that, if you look at it, the fund has outperformed the index, right? Sensex, Nifty 50, Nifty 100, and Nifty 500. So on a 5 to 7 years, 5 to 10 years basis, the fund has done an exceptional job. So it has beaten all the indices. If you look at the difference between the direct and regular, it is typically coming around that 1.2%, right? On a 5 year, 7 year basis, or a 10 year basis, or even on a 5 year basis. So if I look at the negative instances in the first 3 years, the negative instances are slightly higher compared to the negative instances on the um, compared to the index. So, but on a 5, 7, 10 year basis, the negative instances are 0%. So this is better compared to the index, right? On a 5 years basis, essentially. So ideally, we have to look at the median returns. If you look at the median returns, right, on from 5 to 10 years timeline. So if you are this data again, we have looking from 2014. So on a 5 year basis, it is ranging anywhere between 16 to 20%. So again, here for the regular fund, it is from 15 to 19%. So, but if you look at the indices are around 12 to 13%. Sensex and Nifty 50, even the Nifty 100 is around something similar, and even Nifty 500 has done something similar. Right? That means this fund has done exceptionally well on a longer time horizons, and has delivered better returns compared to the index. The alpha it has generated is over 4% across the time horizons from 5 to 10 years time. Right. So this is the data from 14 to 18. Let's see how the fund has performed. So on the 4 to 10 year basis, again, so in 6 months' time, you can see the divergence of the performance, right? Because there is always a gestation period till the time the stocks will give you the yield. So sometimes this gestation period can be a lot higher as well. So in this case, Nifty 500 in a 5 year horizon has delivered around 86% absolute return, whereas the direct fund has delivered 135% and the regular fund has delivered 121% absolute returns. So if we look at from chart 2019 to present day, so from 2019 till 2021, for the 2 years, the fund and the indices have pretty much, there is not much divergence. So like I was mentioning, right, if you look at the analysis on a 10 year basis, on a 5 year or a 7 year basis, the fund has pretty much delivered 3 to 4 percentage points alpha. But there will be periods where the fund will not be performing. Not just this fund, that's the case for many funds because the thesis of the fund manager has to play out. So in this case, for the 2 years, the fund has not done well. So it's not doing well, but it has just tracked the index. Here, it's only for the first 5 months. So, but again, there is a divergence in the performance. So, somebody who has invested in 2019, the person would be having an absolute return of around 220% on direct side. On the regular, it would be around 201%. So, on the Nifty 500 side, the return would be around 131% absolute. So this is in the 6 years time. So which is a very good return even for the index. But this fund has delivered a really very good return. So from 2014 to present day, if we look at it, there will be periods. There are periods where the fund performance and the index performance would be similar. Say for example, during this stretch, right? So this is from 2017 to almost 2020. The returns may be something similar, right? So at 2017, it is at 176 to 250, that is 50%, right? 50% absolute return on a 3-year horizon. And here, even if you are looking at it, again, so from 145 to 200. So that is almost like 40% of absolute return. So in this period, if somebody has invested in this period and if they were not patient enough for 5 years, then their returns would be something similar to the index only, right? And in fact, if you look at it, just before the COVID, the fall was also steep from 267 to one second, 267 to you have it at 205, right? So that is almost like a 30% drop. So here it is 189 to 153. This is like a 12% of 15-20% drop, right? Again, these are short term. In the short term, this is how things will happen in the market. By short term, I mean like less than 5 years. So even though despite this fund doing really well on a longer horizons, if somebody is looking only, if you have observed the returns in the first few years and invested here and waited for only 3 years, then it would not have worked. Had somebody waited for 5 years, then the divergence would have been like a lot higher, right? From 2017 to 2022. You could see the gap, right? That's the reason why you have to invest at least for 5 years, not just this fund, any fund. So now let's look at how the performance of the fund manager is. He has taken over in 2021. So from his time till 2023, first half of 2023, almost the fund has tracked the index. Pretty much his conviction has played out later. So now from the time, so he took over as a fund manager from August 2021. So from August 2021, it has been close to 4 years now. In 4 years' time, he has almost delivered 100% return compared to Nifty 500 return of 50% in the absolute terms, right? That means 4 years is a decent time. Again, 5 years is the minimum time you have to look at it. So another one more year, you will understand, you will come to know about the real potential of the fund manager as well. So if he is able to preserve these returns even during the downturn, he has done really well during the upside. And if he can preserve the returns during the downturn, then obviously this fund manager is a really good one, right? Again, this video is only for an educational purpose only. It is neither a recommendation to buy nor sell the asset class in discussion. See, even before investing, you have to do your own due diligence and check if it is suiting your asset allocation and financial goals. Otherwise, talk to a distributor or a financial advisor and take their opinion. Then only after you are fully convinced, then only you have to invest. Even before that, don't even try investing in the fund. And again, these whatever we have seen are the past returns. That doesn't mean in the future this will play out, right? That's the reason why you have to check what are the underlying which the fund manager has been having during the different periods of time, and you have to understand the thesis of the fund manager, and probably you have to look at the fact sheets of the fund manager of the past, how he has done in the past. So that way you will have more idea. And after that, if you are totally convinced, then only invest. Just don't look at the index, beating the index as the only criteria. Thank you.